Hi there, welcome to my channel where I dive into fascinating economic trends and analyze their impact on society. This video is sponsored by Momoraitsoch Tech and Tools. Arbitrage, a fundamental concept in finance, involves capitalizing on price disparities to generate profits. This practice thrives on the temporary market inefficiencies that cause asset prices to deviate from their intrinsic values. Arbitrageurs play a pivotal role in restoring market equilibrium by exploiting these opportunities. Arbitrage operates on the premise that prices of identical or similar assets should converge over time. Rooted in the efficient market hypothesis, this principle assumes that markets swiftly incorporate all available information. However, various factors like market frictions, information asymmetry, and delays in information dissemination create opportunities for arbitrage by causing temporary price disparities. As arbitrageurs capitalize on price differentials, they engage in buying or selling assets, augmenting trading volumes and reducing bid-ask spreads. This amplified liquidity benefits all market participants by facilitating smoother transactions and lowering transaction costs. In the realm of international finance, exchange rates play a crucial role in determining the relative value of currencies. One phenomenon that I found interesting when I first learned about it in my international economics class is known as overshooting exchange rates. Overshooting refers to a temporary and exaggerated movement in exchange rates in response to economic shocks or policy changes. The cool thing about this phenomenon is that it is not mysterious but is observable by any interested member of the public on the foreign currency markets. Today's discussion, therefore, explores the phenomenon of overshooting exchange rates, its causes, implications, and its significance in global financial markets. Before I continue, however, do visit our website where I curate news and publications from international financial organizations and world central banks. Topics cover a wide range of financial and economic issues that affect individual countries or the world economy. For instance, COVID-19, inflation, or the war in Ukraine. Please also subscribe to this channel and be informed whenever we publish a new video. Overshooting exchange rates are a result of the adjustment process in currency markets. According to the overshooting hypothesis proposed by economist Rudi Dornbusch in 1976, exchange rates tend to exhibit more pronounced and rapid movements in the short term than would be warranted by economic fundamentals. These temporary deviations from long-run equilibrium reflect the market's response to shocks, expectations, and adjustments in interest rates. So, what are the causes of overshooting? Several factors can be identified. Changes in interest rates have a significant impact on exchange rates. When a country raises its interest rates, attracting foreign capital inflows, the demand for its currency increases, leading to an appreciation of the currency's value. The initial reaction to interest rate changes may be exaggerated, causing an overshooting effect. Sudden economic shocks such as changes in government policies, unexpected inflation, or geopolitical events can create uncertainty and disrupt currency markets. Market participants' reactions to these shocks can lead to overshooting as they quickly adjust their expectations and reposition their currency holdings. What are the implications of overshooting exchange rates? Overshooting exchange rates serve as a mechanism for economies to adjust to shocks and restore equilibrium. The temporary overshooting allows for the realignment of prices, interest rates, and trade balances, facilitating an eventual return to long-run equilibrium. Overshooting can contribute to increased volatility in currency markets. The rapid and exaggerated exchange rate movements can create challenges for businesses engaged in international trade, investment, and currency hedging. Higher exchange rate volatility introduces additional uncertainty, making it more difficult for market participants to plan and make informed decisions. Overshooting exchange rates can affect a country's international competitiveness. A significant appreciation of a currency resulting from overshooting can make exports more expensive and imports cheaper. These can have implications for trade balances, as it may lead to reduced export competitiveness and increased imports. Overshooting can influence capital flows as investors respond to changes in exchange rates and interest rate differentials. Sharp exchange rate movements may attract or deter foreign investment, impacting financial market stability. Large and abrupt capital flows driven by overshooting can introduce volatility and increase the risk of financial instability. Overshooting exchange rates have broader implications for global financial markets and policy considerations. Central banks and policymakers closely monitor exchange rate movements, particularly during episodes of overshooting. They may choose to intervene in currency markets to manage excessive volatility or implement policy measures to mitigate the impact of overshooting on the economy. Overshooting can create opportunities for speculative trading strategies, such as carry trades. Investors may borrow in currencies with low interest rates and invest in currencies that are expected to appreciate due to overshooting. These strategies aim to profit from interest rate differentials and potential reversals in exchange rates. Overshooting exchange rates present challenges for exchange rate forecasting. The exaggerated short-term movements make it difficult to predict future exchange rate trends accurately. Forecasting models need to account for overshooting effects to provide more reliable predictions. To conclude, overshooting exchange rates exemplify the dynamic and complex nature of currency markets. They represent temporary deviations from long-run equilibrium as markets adjust to economic shocks and expectations. While overshooting can introduce volatility and challenges for businesses and policymakers, it also serves as a mechanism for economic adjustment and restoration of equilibrium. Understanding the causes, implications, and significance of overshooting exchange rates is crucial for market participants, policymakers, and researchers in navigating the intricacies of global financial markets. That's it for today's video. I hope you found this analysis insightful. If you did, please like this video and don't forget to subscribe to our channel for more engaging content like this. As always, I appreciate your support. Thank you for watching, and until next time, stay curious and keep exploring the world of economics.